Lyft, the American rideshare company that beat Uber to Wall Street but has spent years fighting to stay relevant in its shadow.
The company started as Zimride in 2007, a long-distance carpooling service. By 2012, it pivoted to city rideshare under the Lyft brand and became the pink mustache on the front of your car.
Lyft IPO'd in March 2019, a few weeks before Uber. It was a rough debut. The stock dropped almost immediately, and the two companies spent the next several years burning cash racing for market share.
Then came COVID. Ride volumes collapsed. Lyft cut headcount, sold its bikes and scooters division, and refocused on a single thing, connecting drivers and riders in the U.S. and Canada.
The real turning point was April 2023, when David Risher took the CEO seat. He moved quickly, cutting costs aggressively, simplifying the organization, and restoring driver pay to improve supply.
The business model is a marketplace. Lyft takes a service fee on each ride, the take rate on gross bookings. Drivers keep most of the fare. Lyft earns the spread.
Gross bookings are the total fares paid by riders. Net revenue, what Lyft actually reports, is the slice it keeps after paying out drivers. Gross margins have expanded under Risher to over 40%.
In 2024, Lyft achieved GAAP profitability for the first time as a public company, a milestone it had never reached despite years of U.S. operations.
Uber remains the dominant competitor with a much larger share of U.S. rideshare and significant international presence. Lyft has no international operations. It is entirely focused on domestic markets.
The longer-term threat everyone watches is autonomous vehicles. Waymo is already operating robotaxis in U.S. cities. Tesla has announced a robotaxi network. Both could shrink the market for human-driven rideshare.
Lyft's response has been to partner rather than build. It has agreements with AV developers to bring autonomous vehicles onto its platform, positioning Lyft as the network layer, not the technology provider.
Lyft Media is also a growing revenue line, selling advertising to brands that want to reach riders. In-app ads and in-car screens represent a new monetization channel on top of the core take rate.
The cost structure is now leaner. Headcount is down significantly from peak levels, and the focus on a single geography, rather than spreading capital across international markets, has improved capital efficiency.
Risher came from Amazon, where he led retail. He brought an operator's mindset, cost discipline, and a focus on execution over narrative. That cultural shift is visible in the results.
The core risk is structural. Lyft is number 2 in a market with one dominant competitor facing AV disruption and operating with thinner margins than Uber.
But the bull case is real too. Lyft is profitable, leaner, and focused. If rideshare demand continues growing and AV disruption is slower than feared, the company generates meaningful free cash flow from a durable market position.
Q1 2026 results are in, and the Lyft earnings episode is ready. We will cover gross bookings growth, take rate trends, profitability trajectory, and what management is saying about the competitive landscape.
For the full earnings breakdown, the numbers, and what they mean for the road ahead, stay tuned to Charged Alpha.
Lyft posted Q1 2026 revenue of $1.65 billion, up 6.9%, beating the $1.6 billion consensus estimate by 3%. GAAP EPS of 4 cents missed the 9-cent target as driver incentive costs squeezed margins. That Q4 2025 EPS of $6.71, a deferred tax asset recognition, a one-time non-cash accounting event, not real operating income. We break down what the numbers actually say. This is Charged Alpha.
I'm Lana. Lyft is America's number 2 rideshare platform, behind Uber and well ahead of everyone else. Founded in 2012, CEO David Risher has led a disciplined pivot toward profitable growth since 2023. Market cap, $8.1 billion. This is a turnaround story, quarter by quarter, trending toward sustained profitability.
Lyft operates in the United States and Canada only. No international exposure. Revenue comes from service fees on every ride. $1.85 billion in cash, $920 million in debt. Net cash positive at roughly $930 million. Not a fortress, but stable. The platform processes hundreds of millions of rides in a market shared almost entirely with one competitor.
Q1 2026 revenue, $1.65 billion, up 6.9% year over year. Consensus was $1.6 billion, Lyft beat by $50 million, gross profit $680 million, gross margin 41.2%, up from 38.5% in Q1 2025. 4 consecutive quarters of gross margin improvement. That is the unit economics trend bulls are tracking.
EPS, 4 cents actual, 9 cent estimate, a 55% miss. Net income, $2.5 million on $1.65 billion in revenue. Operating loss, negative $29.7 million, an operating margin of negative 1.8%. The gap between 41% gross margin and negative operating margin is driver incentive programs, marketing, and platform infrastructure, competitive spend required to hold driver supply against Uber.
About that Q4 2025 EPS of 671, it was a deferred tax asset recognition event. Lyft released a valuation allowance on accumulated tax loss carryforwards, creating a roughly $4 billion non-cash income statement gain. The underlying Q4 business had an operating loss, revenue of $1.59 billion, no real profitability. Exclude the DTA, and the trend reads steady, incremental margin progress, not a profitability inflection.
Revenue by quarter, Q1 2025 $1.54 billion, Q2 $1.64, Q3 $1.69, Q4 $1.59, Q1 2026 $1.65. Consistent growth, no blowouts, no declines. Q1 operating cash flow $95 million, the third consecutive positive OCF quarter. Trailing 12-month free cash flow $320 million. Positive and growing FCF from a company that was cash flow negative in 2023 is the core of the turnaround thesis.
Forward estimates, Q2 2026 revenue $1.72 billion, EPS 14 cents. Full year 2026, $6.9 billion revenue, 38 cents EPS. 2027, $7.5 billion, 72 cents EPS. At $13.85 and forward EPS of 38 cents, the forward PE is 36 times, pricing in continued improvement toward full GAAP profitability.
Price to sales, 1.2 times. Uber trades at 3.8. That Lyft discount reflects smaller scale, US-only exposure, and a history of EPS misses. If operating margin turns positive by late 2026, in line with consensus trajectory, the PS re-rating alone represents meaningful upside. That is the valuation setup entering Q2.
The primary bull catalyst is the rideshare duopoly. Lyft and Uber hold roughly 99% of U.S. rideshare market share combined. There is no meaningful third entrant. The barrier is driver supply and rider habit, not technology. Building driver networks from scratch where both apps are already installed is nearly impossible. Lyft only needs to hold its position against one competitor while steadily improving margins.
Unit economics, gross margin up 2.7 points over 4 quarters to 41.2%. Each point of gross margin is $16.5 million per quarter at current revenue. Management has guided for continued improvement. The driver incentive programs that compressed Q1 EPS are optimization investments designed to reduce cost per ride long term, not permanent margin drains. The path to operating break-even is visible by late 2026.
Lyft media and advertising represent a high-margin growth layer. In-app and in-car screen advertising carries margins near 90%, well above the 41% platform gross margin. Every incremental advertising dollar flows almost entirely to the bottom line. Lyft Pink, the subscription tier with discounted rides and priority pickup, reduces rider churn and improves per-rider contribution economics. These monetization improvements are underrepresented in consensus models.
On autonomous vehicles, Lyft has structured partnerships with Mobileye and May Mobility to operate AVs on its platform as a dispatcher, not a hardware owner. This asset-light approach means Lyft could benefit from AV cost structure improvements without funding the vehicle development capital. If AV unit economics mature by 2028 to 2030, Lyft's positioning as the dispatch layer, not the driver cost owner, is strategically sound.
The bear case starts with Uber. Uber generates $53 billion in annual gross bookings versus Lyft's $7 billion, a 7-to-1 advantage. Uber spans North America, Europe, Latin America, and Asia. Lyft is US and Canada only. Uber Eats diversifies revenue across food delivery cycles. Uber has the capital to outspend Lyft on driver incentives in any market, where it chooses to press an advantage. Maintaining share against that scale gap is Lyft's defining challenge.
Driver incentive pressure is the near-term bear. Q1's EPS miss was directly caused by higher-than-expected incentive spend. If Uber escalates driver competition into summer peak, Lyft may overshoot incentive guidance and miss Q2 as well. Longer term, Waymo, Tesla Robotaxi, and Zoox represent an existential threat to the driver-based model over a 5 to 10-year horizon. A platform built on driver supply networks faces structural risk if autonomous deployment accelerates beyond consensus expectations.
Options market heading into earnings. IV rank 68, put-call ratio 1.32, a clear bearish lean. The EPS miss confirmed it. Post-earnings IV typically resets lower, creating a potential premium selling setup in the 40 to 60-day range if you expect the stock to range trade. May strike concentrations around $13 puts and $15 calls define the near-term expected move zone.
Insider activity is bullish. CEO David Risher made an open market share purchase in Q1 2026. Not a compensation grant, a discretionary buy with personal capital at market price. CEOs do not buy their own stock expecting declines. At $13.85 against a $20 consensus analyst target, Risher's purchase signals conviction in the turnaround. This is among the stronger insider signals in the current rideshare sector.
Analyst Consensus, hold, $20 price target, 44% upside. Goldman Sachs neutral, Morgan Stanley equal weight, large cap caution on the EPS miss. Wedbush is outperform, citing unit economics improvement and AV partnerships. Jefferies holds at hold on Uber's structural advantages. The target spread from $12 to $30 reflects genuine uncertainty on margin improvement pace, not disagreement on direction.
Balance sheet, $1.85 billion cash, $920 million debt, net cash positive $930 million, current ratio 1.4, total assets $4.8 billion, interest expense $35 million per quarter manageable, no dividend, no buybacks, all cash reinvested in platform growth. Sufficient liquidity runway through the profitability transition without requiring a dilutive equity raise.
Income waterfall Q1 revenue $1.65 billion, gross profit $680 million, operating loss $30 million, EBITDA positive $145 million, net income $2.5 million, EBITDA margin 8.8%. Adjusted EBITDA excluding stock comp and restructuring runs 12 to 14%. The figure management guides to and the market uses for EV/EBITDA comparisons. At 22 times adjusted EBITDA, the valuation is not cheap but is below Uber's 28 times.
Trailing 12-month free cash flow, $320 million, a 4% FCF yield at today's market cap. Q1 OCF of $95 million was the third straight positive quarter. The company went from FCF negative in 2023 to positive in 2024. That inflection is structural. Incremental rides on fixed infrastructure flow to cash with minimal capex. If FCF hits $400 to $500 million by year-end, the yield rises to 5 to 6%, a historical value entry for platform businesses.
Comparing Lyft to Uber, Uber trades at 3.8 times sales, 28 times EV/EBITDA, 5.2% operating margin, Lyft at 1.2 times sales, and negative operating margins. The Uber premium reflects global scale, delivery diversification, and consistent profitability. The Lyft discount reflects the inverse, US only, no delivery, near zero GAAP profit. The investor question is how much of that discount closes as margins improve. If operating margin reaches 2 to 3% by Q4 2026, the PS re-rating could be substantial even with 7% revenue growth.
DoorDash offers a separate frame, a gig platform peer without GAAP profitability, trading at 5.1 times sales and 45 times EBITDA on 19% revenue growth. Dash earns its premium on growth rate, Lyft at 7% does not. But rideshare is structurally more stable than food delivery, less margin pressure from restaurant competition, less sensitivity to menu price inflation. Rides per capita continue growing as younger urban demographics shift away from personal vehicle ownership. The secular tailwind exists. The variable is how much of it flows to margin.
Bottom line, revenue beat, EPS miss, Q4 DTA event excluded, gross margins trending up, FCF positive for 3 straight quarters. Duopoly structure limits new competition. CEO buying stock. Analyst Consensus target 44% above today's price. The bear case is Uber's scale and AV disruption risk. The turnaround is real. The pace is the debate.
Lyft, ticker LYFT. I'm Hudson. This has been Charged Alpha. This episode is for educational and entertainment purposes only. Nothing discussed here constitutes financial advice or a recommendation to buy or sell any security. Charged Alpha may hold positions in companies discussed on this show. Always do your own research and consult a qualified financial professional before making any investment decisions. Past performance does not guarantee future results.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.